This is the first of our sessions for Broker Illuminati this year. Pleasure to be hosting and running this again for everyone. Fabian was part of our first Broker Illuminati, and one of the sessions we held last year with Fabian was actually going through a worked example of a private loan. And look, pleasure to have Fabian back with us again today. Fabian, probably the best place to start, and obviously we're going to go into some of the nitty-gritty today, but I think probably the first place to start is, how do we define a private loan? We've got a lot of different people on this call, some people that are mortgage brokers, some people work in aggregation, all sorts of different background. How would you define a private loan for the sake of our discussion today?
Yeah, look, I think, a private loan is really essentially a transaction that, for whatever reason, doesn't seem to fit within the mainstream lending, box. So there are a number of factors that can determine that, but essentially, just to put it in very simple terms, you're a broker. You belong to an aggregator, and that aggregator has a panel of lenders. Now, typically, if something can't be done via one of those lenders on your aggregator's panel, then most likely it's going to fall into a private lending market, because all those aggregators pretty much will create a panel of lenders that can do anything that would fit within mainstream lending. If it can't be done by one of those lenders, then the likelihood is that it's going to have to be funded by a private lending lender.
And we're not saying here, Fabian, we're not encouraging someone to go outside what their aggregator's panel is. We're just simply stating that today's session is about helping people understand that there is a world of lenders. And I say world because there's just a lot, certainly now, which really have performed a fairly important function. And I suppose brings me to my next area to discuss. How did you find, for someone who plays a lot in private lending, how did you find your private lenders or private lenders generally in the last 6 months, post-March, post the start of COVID? Have you seen them fill a role? How's that worked for you?
Yeah, in terms of how I found their lending appetite and things like that?
Yeah, absolutely. I mean, obviously their appetite, but what are some of the things that you saw that you could share with some of us who potentially haven't written as many private loans over the last 6 to 12 months?
Yeah, I mean, look, I think like with all lenders, when COVID first hit, everything sort of just ground to a halt. There's probably over 200, 250 private lenders in the private space. I'd say 70 to 80% of those guys literally stopped lending for a period of maybe 2 to 4 weeks when everything went into lockdown initially. There were a few that continued to lend, however, at drastically reduced loan-to-value ratios. So, for example, before, where they would have happily wrote a deal at a 65% LVR, they'd now only look at it at a 45 to 50% LVR. Mm-hmm. So it basically meant that borrowers either had to tip in a lot more of their own cash equity, or the deal just had to sit until things settled down, which is what a lot of deals ended up doing. But I've noticed over the last probably month or two, obviously things have opened up a lot more in New South Wales. Victoria finally is getting there now as well, and all the other states have sort of slowly started opening. So the lenders now are a lot more inclined to want to get back out there and lend. Obviously you can imagine that a lot of money has been sitting on the sidelines for some time now. So just like anything, money doesn't like to be sitting around collecting dust. It wants to get out there and work. So now they're looking for good transactions to deploy the capital to.
Yeah, I must say it was interesting. Someone decided to pirate one of my posts overnight about our session today, and that particular person who decided to do that probably was one of the most guilty parties during that time. We're not going to speak ill of the dead, but
Yeah.
today, while we've got some new people that have joined our conversation today, just want to make sure you're all aware. Please use the chat function. Today is a little bit different than other BD days and sessions you've gone to. The idea is that everyone attends this and gets something out of it. And don't get me wrong, Fabian and I are going to cover quite a lot of different aspects today, but please use the chat function, and I'm happy to cover off on any questions. And Fabian's incredibly accommodating as well. So we will go through, and hopefully if there's anything you wanted to know about private lending today in this 45-minute block, you're going to leave today knowing it. First probably point of call, Fabian, for a lot of people is the session today is about how to calculate and compare a private loan. What are the sort of aspects that I need as a broker to be able to break down and say, well, you know what, that's the cost of this loan. How do I sit down to a client and say, right, this is what it is? Because in fairness, the one thing most private lenders aren't exactly known for is transparency. Help us out.
Yeah, look, I mean, I guess the easiest way to sort of work it out is first and foremost to sort of break down the various different costs that are involved in a private loan. And to be fair, probably 75% of those costs are also involved in a traditional bank lending loan. There are probably just a couple of different costs that probably come up in a private loan that maybe wouldn't rear its head in a traditional lending loan. And one of those is typically the upfront fee that a lender will charge when they issue their indicative loan offer or their funding proposal.
Okay.
So, look, I mean, I'm happy to share with you, Chris. I've got a document that I've created, which is basically a dossier on fees within the private funding space and all the different types of fees, and explains what those fees are. But essentially, if I was going to break it down quickly for you, you typically have, in terms of fees from the lender's side, once they review a transaction and they feel that it is a transaction that fits within their scope, and they're prepared to basically do a formal assessment and look at an approval, they'll issue what they call an indicative loan offer. That loan offer usually will set out the proposed terms of the loan, the fees, the parameters, what are the conditions of that loan, what do you need to fulfill, is it valuations, is it anything that needs to be met. At that point, they'll usually ask the client to sign that offer and pay an upfront fee. So,
and what would that look like generally? Obviously not wholly, it obviously can vary.
Yeah, look, it depends on the loan size, the complexity of the loan. But look, to give you a rough idea, I mean, look, something, all the loans that we've done with the lenders that we use, they typically range, that fee either ranges from maybe $3,000. And, when you start getting into the bigger loans, the 10 mil plus, that fee could go up to 10,000 plus. Now that fee, depending on the lender, sometimes is refundable if the loan is not approved. However, there's some lenders that will keep a portion of it as administration costs for basically doing all the due diligence. So unfortunately, there's no hard and fast rule. It really is dependent upon the lender that you're dealing with. Some will keep the whole lot, even if they don't approve it. And I suppose that's where it comes down to knowing the lenders you're working with. Just because a lender has a clause in there that they keep it if they don't approve it, doesn't necessarily mean they're doing anything dodgy. It could just be the way they operate. They see it that they're doing the work to assess the deal. It's up to you to present a deal that you think will get approved. Otherwise, don't present it to that lender. And I suppose this is where it comes back to maybe something that I was going to share a bit later, but the private space is a different beast. It is a completely different terrain to traditional lending. When you deal in that traditional lending space, whether you're dealing with CBA, Westpac, ANZ, NAB, St. George, you can pretty much expect the same sort of policies and procedures mildly different depending on the bank. Timeframes may be slightly different, but on a whole, it's a pretty similar experience to an extent. In the private space, you could have lender A and lender B have totally different procedures. One will charge an upfront fee, one will not. One may refund it, one may not. So it's really knowing which lender to go to, it becomes critical.
In terms of yourself, could you share with a few of the people on this call some examples of whereby it would be better for a client to look at a private loan versus a traditional bank? Because I know there's a lot of people that simply think, well, hang on, surely it's always better to go for the bank. Can you explain a few examples of that? I mean, the one thing that I find just personally that a lot of people tend to miss, regardless of the transaction, is the opportunity cost. Can you provide a few examples of the types of clients whereby a private loan would actually be more suitable?
Yeah, so look, I think the most obvious one is probably in the construction space, and talking about timing in terms of, let's say I'm a developer and I want to build a block of 10 units. I approach my bank that I've had a relationship with for a long time, or my broker approaches the bank. But the bank comes back and says, yeah, look, we like this deal, but in order to get this over the line with us, we're going to need you to sell 4 out of those 10 units as pre-sales before we'll even give you a cent. So the client has to look at their options and think, okay, how long is it going to take me to sell 4 of these properties? And will I have to reduce my asking price on these properties in order to sell them essentially as a pre-sale before I've even come out of the ground? So they look at their options and then they think, okay, let me look at a private lending option. So straight away, the first thing that will stick out is the interest rate's going to be higher, the line fee is going to be higher, and the establishment fee is going to be higher. And you're probably going to have to pay an upfront cost to the lender. So straight away...
Sorry, Fabian, so to confirm, there's still lenders out there happily doing lending in the private space without requiring a pre-sale? Yes.
So it comes down to a number of factors.
And is that at all levels? What sort of size? They're doing that up to 2, 5, 10 mil?
It really depends on how much cash equity the developer puts in. So if you've got anything in that sort of sub 5 mil space, you can quite easily probably get a deal away with no pre-sales still. As you get into the bigger stuff, the 10 mil plus, if you want no pre-sales, you've really got to put in a little bit more equity, probably closer to 50-55% maximum loan to value ratio of the end value. And you can probably still convince a lender to do it with no pre-sales if the location is right. But the first thing in a private space that probably differentiates it to traditional lending is, you go to CBA, and if you're buying a property in location, in a metro city location versus something maybe in a regional or major regional, like say, for those that are in New South Wales, if I'm buying something in Manly Beach, which is a Sydney metro location on the water, versus maybe buying something in Gosford, which is also a nice water side location, but it's not in Sydney metro.
Those people from the Central Coast on this call.
Yeah, look, sorry, I didn't mean it that way, and I hope I'm just trying to differentiate metro to non-metro. But essentially, if you go to a bank, you're going to probably get the same interest rate on both of those purchases. In the private space, your interest rate will be different because the private lender is basically just thinking worst case scenario. If I need to exit our position by selling this property, the one in the Sydney metro location is going to be a lot easier to move than one in a major regional location. So that's probably one area where it differentiates straight away.
The comment you made before about how easy it is to move probably important for everyone on the call to know, well, hey, if I go to a bank, hey, people are now doing 25, 30-year commercial terms. I mean, most people knew 10 and 15 years. What sort of term would I be looking at for a private loan?
Yeah.
And if I'm worried about moving it on, obviously there's a pretty key difference there too, right?
Yeah, so look, in the private space, lenders will typically restrict themselves to a maximum of maybe 3 years. To be frank, I haven't written a loan at 3 years at this point. Everything's been either 12 or 24 months. And the reason is that these are they're short-term facilities. They're supposed to be a facility that solves an issue for you that for whatever reason can't be solved in traditional lending. But the idea is, because rates are obviously a lot higher than a traditional lending space, you don't want to sit in this private space ongoing for the long term. So it's usually 12 to 24 months. A lot of these lenders, if the facility is conducted in good conduct over that time, they will give you an option if you want to roll it over for another term. But typically, it's not the ideal place where you want to sit long term for 10 years in a facility.
To your point before, though, one of the reasons why someone finds themselves in a private loan situation is because they might not be able to service a traditional bank loan. How is servicing different in a private loan situation than a bank loan?
Yeah, well, look, I suppose the first thing that I should make clear is that private lending space, or the majority of the private lenders, or all the lenders that we deal with anyway, they don't deal in coded loans. So everything is non-coded. So I suppose when you talk about serviceability, we're talking about from a commercial perspective. They don't really look at serviceability in the private space. And the main reason being is that private space is an asset lend traditionally. So when I say asset lend, they're basically lending against the value of the asset and the interest component. So if you've got a 12-month term and let's say there's $30,000 worth of interest, that usually gets prepaid upfront and deducted from the gross loan amount.
Okay.
So yeah, so there's essentially no repayments that are made over the term of the facility. Now, there are some lenders that will allow you to service the loan. Typically, they want to sort of see, though, how that's going to happen. So do you have rental income from the asset? Do you have, income from other assets? Look, they don't typically run a servicing calculator per se, like a bank would, down to the numbers, but they do want to see some sort of verification about how it will be serviced if you elect to do that, whether that's a letter from the accountant or a copy of a lease that demonstrates rental income. But typically, probably 70% of the time, interest is just capitalized and deducted up front.
In terms of obviously being a broker who's focused in this area for quite some time, there's certain things that you've seen that some of us, if we don't go, and I speak for a few people here, there's a lot of people, it doesn't matter what we're looking at, whether it be a private loan, debtor and trade finance, equipment finance, there's a lot of areas we cover over this week. But the biggest barrier for a lot of people is, what if I don't, what can go wrong? And obviously with private lending, there's quite a few things where things can go wrong. And you and I have worked together on some clients and we've seen it ourselves. Yeah. Do you think you could share with us maybe one or two of the aspects that you've seen where things have gone wrong that potentially we could avoid going forward from your experience? What are some of the things that you've seen? For example, look, with my debtor and trade finance, I've made a list of 25 different things that could happen. But by going through and solving those things, obviously it's got me to the level I am today. Can you share with us one or two of the aspects that for yourself you've learned, those learnings along the way, if you will?
Look, I'll share a couple that I think that stick out straight away. First and foremost, one thing to remember, especially in the private space, or with anything in lending, it only matters if the loan settles. The outcome is only achieved if the loan settles and the clients get the money that they need. If they don't end up settling, then the whole thing was for nothing. So why I say that is that there is no point when a deal comes in if the valuation on the asset is overinflated. So if a deal gets sent in and it says the development site is worth $10 million, right? And they've said it's $10 million to make sure that the LVRs stack up so that they can get the indicative loan offer and everything looks good. But when the valuation gets done, it only values up at 8 million, the whole thing falls over. And what happens is, typically in a bank, if that happens, the client maybe is out the valuation cost. But in a private space, they may be out an upfront fee to a lender. They may have lost valuable time. So the whole thing falls over. There's no point. So I guess making sure that valuation estimates are accurate as they can be, based on real sort of numbers. There's a number of other things. The valuation is one. Making sure there's no skeletons in the closet. Now, a lot of the time, I've had it told to me before, at the last minute, a credit check is done and it comes up that the client's been bankrupt or they've got criminal proceedings pending against them. And the brokers just said, well, it's private funding, who cares? But the thing is, even though these are private lenders, a lot of them are still, I suppose, the ones lending in single digits. So, a single digit private lender is still running some sort of credit verification and wanting to make sure that the borrowers are trustworthy and credible individuals. The ones that are happy to lend against basically any borrowing entity or any director, you're probably paying high double-digit interest rates for those lenders. So it's important that first and foremost, if someone's in the private space, it's totally acceptable that they may have something that's a little bit left field, whether that's a tax debt. Maybe they're in dispute over something. There's some court proceedings that are underway. The most important thing is that everything's disclosed up front. So if the lender gets a little bit of a summary, look, this is the situation, this is what's happening, totally transparent, that helps. So just making sure that you try to cover off everything, and you'd be surprised what you can find on Google these days.
100%.
And that's not to say that,
point.
not to say that everything is true that you read on Google, but if you're presenting a deal with a sponsor that, if you do a Google search on his name, and believe me, lenders do Google searches on the borrowers' names, and something comes up, at least give a little bit of context when you present it about, look, you might see an article that mentions this is what happened, this is the story. If that's presented to the lender when the deal gets presented, I can assure you that it probably goes a long way to them basically maybe forgetting about it or not placing a big importance on it because it's not an unknown.
That's a great point. Has happened to me many times. And a Google search, quite frankly, is something that everyone should start with in 2020 and beyond. Yeah. Unfortunately, that's the nature of where we stand. Just to your point, though, we were talking about single digits and double digits. Probably important to dig down, though, and talk about there's no comparison rate in private lending. And you and I both know some lenders out there with single digit interest rates. But if we actually look at the cost of client, when we look at our application fees, monthly fees, remembering these are short-term loans, a lot of them. So we talked about loan terms being 12 to 24. And yes, 3 and 1 or 2 are in that 5-year category, but it's rare as hen's teeth. There's many people in that shorter term space around that 6 to 12 months. So when you start looking at some of these fees and you look at the actual implications to the interest rate, certainly the level of security changes things. So obviously you'd be aware and you play in all of those different categories. But in terms of the actual rate to client, maybe if you could comment a little bit there about how that can vary in some of the different, you talked about servicing before, but I'd sort of, given the nature of this session is about comparing different private loans, maybe you could talk for a few of the people on this call about the risks of those lenders that decide to put their low rate in the window and all of the things in the back end.
Yeah. So look, I mean, as Chris said, there's a number of lenders that may present quite nice upfront in the beginning, but they may have things hidden in the fine print, such as exit fees. So the interest that they don't collect up front on the interest rate, they may collect it as an exit fee. So they may have a clause in the fine print of the loan documents that say, upon exit, you must pay equivalent to 2 months worth of interest as an exit to exit this facility. That's just an example.
That's fairly hefty on a 6-month or a 12-month term.
Yeah, I look at.
Obviously, you and I know this, but there's a lot of other people on this call that don't. So it's important to sort of flesh that out.
Yeah, and look, you'd be surprised. I've heard some horror stories from people. Even things like loan terms, for example. A lender will typically charge a rollover fee, which is usually the equivalent to their establishment fee. If you get to the end of the term and you can't get it out. So be wary sometimes of making sure you estimate that loan term correctly, because sometimes a lender may try to push you into a shorter term, a 6-month term, knowing full well that you probably may not get out in 6 months. So you're going to be forced to potentially maybe roll it over, which means another estab fee. So make sure that you've estimated your loan term and your exit strategy correctly. There's things to keep an eye on, like the default rate. Now, look, it's very, very normal and common that private lenders have default rates. And essentially what a default rate is, as long as your facility is kept in good conduct and you're not sort of breaching any of the requirements of the facility, you will pay your normal interest rate, whatever you're quoted. But if you breach any of the covenants in your facility agreement, for example, if you're servicing your loan and you miss a payment by a day or 2, that technically means your loan's in default, and they will charge you the default interest rate. Now, not all, but a lot of these lenders will charge their interest up front for the month. So on the day 1 of the month, they charge the full month of interest up front. So if you just happen to miss your payment by 1 day for whatever reason, and they default you may likely have to pay that full month of interest at the higher rate, even though you may make the payment 2 or 3 days later. So there are lenders that you can work with, that you can negotiate with, that will be friendly in that instance and will allow you a grace period before they whack you. There's others that are very cut and dry, and these are the rules. And if you step outside, this is your punishment, basically. So again, knowing which lenders are the ones that are a little bit more user-friendly and which ones are very black and white also helps. One thing to just be wary of on the default rate is, look, it's pretty common that a default rate maybe sits 4, 5 or 6% higher than the actual rate. That's probably the norm. Where I'd get a little concerned is when you see a default rate that is massively higher than the interest rate. So if you've got an interest rate of, say, 8%, and someone's got a default rate of 22% or 25%, that would be a bit of a red flag, because that sort of suggests that they're really potentially hoping that you're going to default, and they're going to whack you the first chance they get with no leeway, no room for discussion. It's usually when a default rate is that high, the lender is basically shaping up to get you as soon as you step out of line. So look, these are obviously a lot of little things that I've learned the hard way over many years, but they're just little things to look at. Just one thing to keep in mind, it's about being vigilant. Again, it doesn't necessarily mean 100% that if a lender has a higher default rate, that they're a crook and they're trying to get you, and it's just, if I see that, it means be extra vigilant. Make sure you really read through everything. Make sure you understand everything. That's the gist of it.
And from a broker's perspective, Fabian, just to add something to that, incredibly important when it comes to private loans to make sure you've documented your discussion, you've gone through that, because at the end of the day, forgetting the fact that these loans aren't coded, there's obviously, I don't know, I'll speak for myself, maybe my moral compass is too high and mighty, but at the same time, I think it's important to make sure that you do make notes along the way and make sure you've gone back through and you've spent that time. Now, we've tried, whilst I think that we've talked about some of the nasty parts of private lending, we also covered off the fact that, look, there's people that need these funds regardless. There's an opportunity cost, especially in that construction space. Hey, if I have to turn around and sell a few of my units before I'm getting the market value, then there's an opportunity cost. So, and it may well be that for other clients, certainly some that I've seen, hey, someone wants to be able to delay their selling decision. I think we're going to see a lot of people coming forward that want to delay their selling decision. Can you maybe call out, say, one or two scenarios, types that people on this call should look for if they're looking to get in and identify opportunities for private lending? Certainly going forward, I would imagine there's going to be quite a few, but I'd like to hear your perspective on that.
Yeah, so look, I mean, obviously the first and most obvious one would be in construction lending. And if you have a transaction where your client is building something and you've taken it to a couple of banks, and all of them are basically asking for pre-sales, you may want to look at the option then of saying, okay, let's look at a no pre-sales option. I think in that instance, most developers will usually find that the extra cost of the private funding loan option will be more beneficial to them than the cost of actually trying to sell things ahead of time at a discount. When they weigh it up, most of them sort of come to the realization that it's far more better in their interest to get building straight away, and then to start to sell when they're ready, as opposed to doing it before they've even come out of the ground. The other thing with anyone here that it would ever think of buying an investment property or a unit off the plan, you probably want to see that the developer is building something first, rather than just a big pile of dirt with a sign on top of it. So before you start to maybe negotiate with a developer and do anything like that, you'd want to see something out of the ground. So developers also know this, so they think it's going to be very hard for them to negotiate a good price when they've virtually just got product specs and pictures to show you. So pre-sales is probably the first thing I'd keep in mind. If I see something where a developer really wants to get building right away, that would be straight away a thing to say, okay, let's look at a private lending option with no pre-sales. The other would be potentially a loan-to-value ratio issue. So if you've got someone buying a piece of land, in bankland, anything that's classified as a land bank, where a developer is basically buying a site is not ready to develop on it yet, so he's essentially just buying the land. That's what they call a land bank. In a bank, you're probably looking at a maximum of 50% loan to value ratio, all up on something like that, maybe even less depending on the location. In the private space, you could potentially get up to 60, even 65 if it's a good site. So essentially what that means is that developer could potentially take that extra 10 or 15% that he would get on the loan to value ratio, take those funds out, or the funds that he would have used as cash equity into the bank loan, he can now use those funds to go and fund his DA and planning costs and probably progress things, much faster. So come the end of that year, he might be ready to go straight to construction. Whereas if he didn't do it via the private option, he wouldn't have that, maybe have that cash equity available to do that planning.
Sure. Look, I've got to add one more scenario just because I personally think that it's going to be critical, and that is the amount of commercial properties whereby exactly like you've mentioned, where loans are up. We've had a period of time whereby the government has made it more difficult and challenging for people to call in their debts, and I would imagine there will be a lot of people that are between situations that might not want to roll over a facility, but might want a little bit of more time to sell. Now, CBA, I noticed, made a call the other day. They've decided to announce a moratorium on any forced sales in residential space up until September 2021. I don't know whether that same moratorium will be placed in that commercial space, but I think it's important for other people on this call to realise, you made a comment about default rate before. Loan covenants are actually far from limited to just private facilities. In fact, a lot of the bank structures have covenant reporting as well. Maybe just before we start wrapping up, if you could cover off a little bit about what are the sort of covenants that people would see from their mainstream bank, which might become an issue in the next 6 months.
Yeah, look, I mean, I'd say the most glaring and obvious one, and the one that we're sort of getting a lot of inquiry from, is potentially around the LVRs. So, banks may have, just like I said, on a land deal, they may have a covenant that the LVR cannot exceed 50% at any time. They conduct annual reviews on all these facilities. And when they conduct their annual review, given COVID, the values may have come off a little bit. And now all of a sudden that facility is sitting at 55%. So they give the borrower two options: either A, you tipping some cash and drop the balance of your loan so that it meets the covenant, or B, you take the loan out. Now, the issue that developer or that borrower is going to have, and sorry, that doesn't just apply to land, it could apply, just like Chris said, to anything: commercial property, a warehouse, a factory, anything. So if they can't tip in extra cash to bring the LVR to its required level, they've got to get it out at least for a year or two, maybe until values pick up again. And that's where the private lending option could come in handy, because obviously you can maybe go to a slightly higher, that 55, maybe even 60% loan to value ratio, cap in maybe a year's worth of interest. And in that time, you might be able to see property prices start to come back a bit, or at least it buys you a year of time to sort of see what you want to do. Maybe you want to sell the asset. Maybe you want to, maybe you need a year to bring in some extra cash equity so you can bring it back down and then take it back to the bank. So the LVR is probably the most obvious one. They may have covenants in there regarding your financials. They may want to see obviously updated financials to see where you're at in terms of income to see if you can still meet servicing requirements. Again, if that becomes an issue, it's going to be an issue across all lenders in that space. So you may need to look at potentially a short-term facility where you take it out, allow yourself to get your business back up, trading to the numbers that are required, and then bring yourself back to that space. So they're probably the two most obvious ones that I'd probably would see most inquiries about.
So, Fabian, I've attended this Zoom call. I'm looking to do more in that private space. I'm looking to look after more clients' needs. You've been a broker. How did you get in? Two-part question to finish up. How did you start getting into doing commercial loans and private loans yourself, firstly? And the second part, can you give us one or two tips for how any of the brokers and groups on this call could then look to service more clients in that private loan? Specifically, what would they do in terms of database call? What would your next steps be?
Yeah, look, I mean, sorry, the first part was sort of how I got into the space. Is that, yeah?
Yeah. How'd you get into it?
Yeah, I mean, look, it sort of fell into my lap, to be honest. I started just getting a lot of commercial inquiries, and naturally, some of them were out of the box, so I was forced to start looking into other alternate lenders. Look, originally I had a panel of 6 lenders, private lenders, and I thought that was the private world. And I would just, copy and I'd create a little bit of a scenario and copy and paste all 6 lenders into the BCC field and send it off, and see if anything came back. Look, obviously, being a bit more experienced now, I realize that's probably, the worst thing you can do in a transaction. First and foremost, the lender receiving it doesn't really take it serious if it's not addressed to them personally. Secondly, you don't even know if you're sending it to a lender. For example, some private lenders don't do construction; they just do land or property. Other lenders may only want to do construction; they don't do land. So if you're sending a construction deal to a lender that doesn't do construction, you can be sure that lender's probably going to place you on a bit of a don't even bother looking at this guy's deals when they come in sort of list. So a lot of little things like that I learned the hard way. I started building a database, and I make it a practice every week. I talk to private lenders. I try and find new ones that I don't know about and try to learn more about them. What are their parameters? What are the things they like? I think when you first get into the private space, you're so fixated on rate and fees and all of that it's the only thing you look at. You just want to get the sharpest rate and lowest fees and be able to present it to your client so that they think, wow, this guy's done a great job. But being in the private space, after a while, you start to realize the most important thing that a client really wants is deals that settle, that they get done. They get done in a timely way. They get done with reasonable pricing. So over the course of time, I started cherry picking and realizing, okay, here's a group of lenders that are reasonably priced. They're good to work with. You can negotiate with them. You can work through deals that are a little bit out of the box, and they're not crooks. They're in there for the long term. They want to do business with you in 10 years' time. They're not just here to take money, do a deal, and never, they don't care whether they see you again or not. So that's sort of how I stumbled into my knowledge. Sort of came from a little bit of pain over the years, learning things the hard way, slowly building it. Sorry, what was the second part of the question again?
Look, it's interesting because I've had some feedback privately on the chat, and just before, appreciate if you don't have the time and you need to duck off. For the other people on the call, someone's asked me just briefly on a private thread, are we covering our favourite private lenders and why? And alternatively, are there any to avoid? Now, I'm going to take some of that from you, Fabian, in that it's interesting. I personally think that lenders change their appetite all the time. And to turn around and call out a lender to avoid based on your experience with them, it's a very interesting one, because I'm sure there might be one or two that you and I have had negative dealings with. But my answer to that particular person is that you just can't take for granted that the people that you're, speaking ill of don't pop up in another lender. And as you say, private lending, there is a lot more lenders out there in the space, but their appetites do change up and down quite consistently. I mean, don't get me wrong, there's one or two I'd love to call out for the group, but at the same time, those one or two, with a different owner, different funding structure and everything else, they might be a zero today, but might be a hero tomorrow. So for mine, I would call out and say, look, to your point, when you say that clients want things to work quickly and settle and be done the right way, so do the lenders, because they don't have the time or resources to sit there and sift through 100 applications. That's why it's important that they work with people that they know and trust. Yeah. So to the question that's come through, hey, really appreciate it. And if there's any quick ones, happy to try and address them before we cover off. But my thoughts on that, Fabian, and you and I have spoken about this plenty of times. Yes, there's one or two that are great, but they won't necessarily be great for everybody. It's a matter of the sort of transactions you bring, the sort of submissions you bring, and that you can't turn around and say, it's not like we're saying, oh, CBA is the best lender in this space because they buy it. It doesn't work. It's not a cookie cutter situation.
Yeah, so that's right. And look, I'd probably finish up by maybe giving this advice. In that private space, I would give you two options that I would pursue if I was a broker new to this space. First option is either A, you put in the time and the effort to really understand the space, to really learn and speak with the different funders in the space, understand their policies, understand what are the risks. No shortcuts, basically. Put in the time to really, really educate yourself on the sector, on the industry, and people on this call, they're already, that's a step. They're putting in time, they're taking time out to learn. There's no shortcut. You have to speak to the lenders. You have to learn. And unfortunately, there's going to be some pain along the way. You will engage with a lender that may, slightly potentially damage a relationship with one of your clients because the lender has done something, or maybe they haven't even done anything wrong. Maybe it was just something that you weren't aware of that happens in the private space that you didn't tell your client about because you weren't aware of it. And the whole thing is just gone pear-shaped. So you have to put the time in. If you don't have the time to really learn and put that effort in, then you have to partner with someone that does. And I use the old expression, sometimes 50% of something is better than 100% of nothing. So there's a lot of brokers. We work with a number of different brokers. There's some that will do their best to try and get it placed themselves. But if they can't, or if they don't have the time or the resources, they'll send it to us and ask for a clip of the commission. There's others that will basically want to do it all themselves. And if they can't do it themselves, they'll just let the deal go. There's no right or wrong answer. All I'll say is that whichever way you go, you have to sort of put that effort in. So either put the effort into finding the right partners to work with, or put the effort into learning who the right lenders are that you should be dealing with, and then learn everything you can about those lenders and their policies and their parameters, and just build your own little panel of lenders that you trust, just like you've got your own panel with your aggregator. Build your own little panel of private lenders. So
to that point, that's probably a great space to wrap. Fabian, look, thanks for your time. Before everyone disappears, just a few things to cover off on. Look, some great points there, and obviously, being a broker myself who works with other brokers, it's important to have that level of transparency with people you work with. And Fabian is one of the best. Otherwise, I wouldn't include him as part of Broker Illuminati. Broker Illuminati, the whole reason we use this phrase Illuminati is Illuminati technically is meant to be a secret society. And what better way to talk about a secret society than talk about private lending? Because most people seem to think it's a little secret world. I think with people like Fabian and some of the other people within the space, a lot of people are trying to do their best to demystify that. Thanks for the offer, Fabian, to provide some paraphernalia in terms of fees and comparisons, and I'll make sure they're made available at the end of today.